This has been one of the key issues. We talk about the Treasury, the longer-term Treasury curve rallying. You see 10 years, 30 years rallying, which is not what the Fed wants to see. So how much can you lean into that trade when that eases financial conditions and causes the Fed to go harder on the front end?
I think that exactly is the conundrum that the Fed is facing and will continue to face over the next couple of months. They don't want financial conditions to ease as they move to a slower pace of rate hikes and eventually a pause. And that sort of the cross-section between higher rates and the Fed sort of indicating that they don't want that financial conditions to ease is going to create a little bit of a pickle, because the more that we see financial conditions ease, the higher that the Fed is going to ultimately have to move rates. And so they need to really navigate their language in terms of indicating that they're moving to a slower pace because that's what the economy needs right now. But by no means do they think that this is, off to the races in terms of moving towards a rate cut. Right now, keep in mind that the forward curve for interest rates is pricing in about 2.5 rate cuts next year. It's been a significant and dramatic repricing since the last CPI print. I think that that's overly aggressive versus what the Fed is ultimately going to deliver.
And that's what basically the Fed has been saying repeatedly. No, you guys are wrong. We are not going to be cutting rates because we are concerned about how sticky this inflation is. When you take a look at how bonds and stocks have been correlated, with bonds yields going down and stocks rallying and bond yields going up and stocks selling off, when does that break down, right? When do we start to see something where lower yields on the long end is bad news and comes in tandem with a real risk-off feel? That's what seems to be what you're talking about.
It's exactly what I'm talking about. In every single recession that we've had over the last 40, 50 years, we've seen stocks and bonds negatively correlated as we move deep into the recession. When you're in a late cycle environment, which arguably we've been in over the last year or so, typically you actually see bonds perform poorly as you move later cycle. The market starts anticipating Fed hikes, bonds start to sell off, and equities also can sell off in tandem. But as you move through a recession and deeper into a recession, that's when bonds start to outperform. I think that there's two necessary conditions that need to be met before we start to see that negative stock-bond correlation resume. We're probably approaching that over the next month or two. The first is really see a firm crest in inflation and start to see inflation start to move lower. We've had one print on this side, the most recent print, but we need to see a couple of more inflation prints to really give credence to the view that inflation truly has peaked. The second is that we need to see bond market volatility start to subside, and probably related to that, we also need to see the Fed start to slow their pace of rate hikes. So we're getting to that point where I think you'll start to see more of those traditional stock bond correlation benefits start to help portfolios. But we're not, we haven't certainly firmly and credibly approached that yet. And so we're really waiting for those two catalysts.
This might be a good year, 2023, for the long end of the Treasury curve. But what about credit? I mean, perhaps investment grade, I understand. But riskier credit, it's held in there. Why will that do well, too?
So I think you really need to separate credit between those that are remote default risk and those that are closer to potential default risk, have a higher probability of default. I think those companies or those credits that are high quality, that are investment grade, and that have good free cash flow generation, don't have over leveraged balance sheets, and can operate in an environment where nominal GDP growth is not exceptionally strong and potentially even negative. I think those sort of high quality corporates will do well over the next 12 months or so. You've seen significant spread widening year to date. These companies are trading at good relative valuations versus equities, and so I think that's where you want to park your bets. I would stay away from high yield.